Now, this presentation is being recorded. Even those who are not around, they will also be able to access it later, just the way you have joined the session. So after this, you can also join the same way. The only challenge is that now we are going to take the attendance during the lesson. So those who will have not have attended the lecture, the attendance will not be taken. Remember, we have a policy that for you to sit for an exam, you must have met the 75% threshold. So it means you must have attended at least 75% of our lectures. So please take note of that. We will also be doing exercises in our discussion forum. So immediately we finish maybe the live session, we will go back to the discussion forum. So please ensure that you are active, because that allotments on the discussion forums. So please make sure that you are online for the discussion forum. Now, our cards and assignments, we will do them the same way that we are used to. I know you are not new students, so you know that you will have 2 cards and 2 assignments, all totaling to 30%. And then the end of exams will be out of 70%. So I think that is what you needed to know in my introduction. So we can move straight away to our lesson for today, current purchasing power accounting. Now, the objective of this lesson is that by the end of the lesson, we should be able to, 1, describe historical cost accounting. We should also be able to describe the current purchasing power accounting. And apart from that, there are also some journal entries that are expected of us. Remember, this is accounting. So I expect that even now you have your calculators on, because we are going to use our calculators. And please ensure you also have a book and a pen near you, because it is just the same way that we attend the other normal classes. There is some attachments. I hope you can see them, but I know you can't view them. So after this lesson, I'll activate them. There are also some videos that you can watch at your free time based on the same topic again. So let us start by looking at the current purchasing power accounting. Now, it is abbreviated as CPPA, CPPA, or CPPP. CPPP simply means current purchasing power accounting. So in some books, they abbreviate it with CPPA, in some books, CPPP. Now, it is also known as the general price level accounting, and it is just a method that adjusts the historical cost for changes in the general price level as measured by the general price index. Now, those changes that are in the general represent the changes in the purchasing power of monetary unit. I hope that the shilling today is always worth more than a shilling tomorrow, because the shilling today has got more purchasing power than if you are given that same shilling to spend maybe after some period of time. Then you can also note that it is a mixture of methods in which the financial statements are prepared on historical basis. And these statements end on the current purchasing power of the currency. Assume that you are using maybe Kenya shillings to maybe buy some US dollars and so on. So that is what we mean by currency. Now, the items of the profit and loss and balance sheets are also adjusted. So we will adjust every item, both the monetary and the non-monetary items. Now, the basic ideas of the method are to incorporate the changes in the value of money as a result of the changes in the general price. Maybe lock your webcams so that we concentrate well. The others will not be able to see the other friends' webcams. Now, under CPP, by restating the historical cost, the financial statements for changes in the general purchasing power statements would reflect the original amounts in the terms of the current purchasing. In historical cost accounting, the price does not change. If you have 1,000 shillings and its value is maybe 2,000 in December, then the difference, not the purchasing power. They will have different values. Also, the items are translated at the current rate. So the current rate in which in the period in which you are dealing with the accounts. But for the non-monetary items, maybe the fixed assets, the stock, plant, and the buildings, they are translated at historical rates. So at the rate at which they were acquired. Now you will find that is just a collection of different machines. More machines compacted together, they will form a plant. So that is the meaning of a plant in accounting. Now, during a period of rising prices, holding monetary assets result in the loss of purchasing power. So during the period of rising prices, what we mean is that during during inflation, during that time, you will find that now the monetary items will result in their loss of purchasing power. And but during deflation now, the items will increase in their purchasing power. Deflation is a period where now the prices, now instead of moving up, they will now be moving downwards. Now, likewise, creditors also tend to gain during a period of rising prices, as debts are repaid maybe in dollars. Then them also they will also lead to a decrease in their prices. Now, non-monetary items such as the stocks, the plants, and the buildings, they increase in value. We have already talked about that. Then the lower of the cost and net realizable value can be taken and adjusted further. So we will demonstrate that practically so that we see what we are talking about. And the price index that will be used could be the cost of living index or the consumer's expenditure or even the general index of the retail prices. So that is what we'll be using. But now for our case, now you will find that we'll be given the price indexes that we will be using, so you don't have to worry about the price index that we will be using in our case. If we continue, there are three techniques that we can use now to illustrate and also to help us to understand CPPA accounts. Now, the first method is the conversion technique. First method is the conversion technique. Now, in the conversion technique, it is a method in which the historical figures are changed at a current purchasing power. Historical figures are changed at a current purchasing power. Now, in this case, the items in the profit and loss and also in the balance sheet are all adjusted with the help of a general price index. They are all adjusted with the help of a general price index. Now, in such a case, now the conversion factor, you will divide the current price index number, by the previous price index at the date of existing figure. So you divide current price index number by the previous price index at the date of existing. That will help us to get the conversion factor that we will be using. So if, for example, we have a building which was purchased in 2018 for 160,000 shillings. Then we are told that the general price index in 2018 was 250. So we are told to convert the figures in the current shillings in 2019 when the index was 500 shillings. So remember, we have said that the first thing to do is to, first of all, get the conversion factor. Now, in our case, to get the conversion factor, we will divide now the current price index by the previous price index. So our current price index is 500. Our current price index is 500. So when we divide the 500 by 250, then now our conversion factor will be 2 times. We divide 500 by 250. So that will give you 2 times. So to convert the value, which was 160, what we'll do is to multiply the historical cost, which was 160,000, multiply the historical cost, which was 160,000. You multiply it by the conversion factor, which is 2 times, and that will be 160,000 times 2, and that is 320,000. So that will be the new converted value in 2019. So I would like maybe to ask if there is any clarification that is needed. Your microphones are on. The microphones are on. Yes. Now, our first technique was conversion, and we have shown how you can convert. Any clarification? Okay, the second technique is the mid-period conversion. Mid-period conversion. Now, in the mid-period conversion, there are several transactions which takes place throughout the year. Maybe, for example, the purchases, the sales, and even the expenses. Now, for us to use this method of conversion, for such conversion now, we find now one index for maybe all such items. When the index is not available, then the index of the media can be taken. Index of the media can be taken. Now we are talking about the second technique, which is the mid-period conversion, and you have said that for conversion of items such as purchases and sales and even the expenses that are made during the year, we take the index of the mid-year. Now, number three, Third technique is monetary, is when we are using now the monetary and non-monetary accounts, monetary and the non-monetary accounts. Now, for the conversion of historical costs in terms of the current purchasing power of the currency, the monetary accounts are those accounts of assets and liabilities which are not subject to reassessment of their recorded values owing to the change of purchasing power of money. So that is monetary and non-monetary. Now an example, assume that we had values for January 2018, the corresponding value in December 2018, January 2018 and December 2018. So for current assets in January, the value was 25,000. And in December, the value was 37,000. Then for current liabilities, in January, value was 30,000. In December, 40,000. Then we have the retail price index. In January, the retail price index was 200. Retail price index was 200. In December, retail price index 300. Now the average for the year, we have been given the average price index as 230 shillings. Then asked to calculate the net monetary value. We are asked to calculate the net monetary value. Now, we have the values in January and then also the corresponding values in December. We have retail price index again for January and the retail price index for December that has been given. So to solve this, first of all, we have to get now the value of monetary liabilities. Now, if we look at the value of current liabilities in January, we had 30,000. Value was 30,000. Remember, the price index in January was 200. Price index in December is 300. So to solve that, we will now take the 30,000, so that 30,000 times the price index in December, which is 300. Then we divide the product by 200. So if you calculate that, for those of you who are having their calculators on, that gives us 45,000 as the monetary liability. Likewise, move to, if we look at the value of liabilities in January. In January, the value of liabilities was 30,000, and the value of liabilities in December, 40,000. Now, there is an increase in liability from 30,000 to 40,000. Now, the difference there is 10,000 shillings. So again, for that 10,000, we have to get its conversion. So remember that in December, the price index in December is 300, but the average for the year is 240. Remember that increase has occurred between January and December. So you cannot use the price index for January. That is why we have to use the average price index, which is 240. So if you use that 10,000 times 300 divided by 240, that will give you 12,500. Now if we add 45 to 12,500, now the sum there is 57,500. 7,500. And remember that the ending balance of current liabilities, here is 40,000. So if you subtract the 40,000 from 57,500, now what we'll have is 17,500. Now this 17,500 is again in the monetary liability. There has been an increase in the monetary liability. The monetary assets, again, we follow the same procedure. Remember, in January, we had 25,000, and in December, we have. So we want to convert this. Remember, in January, the conversion factor is 200. In December, the conversion factor is 300. So we will multiply 25,000 by 300 divided by 200. 5,000 by 300 divided by 200, that gives us 40. That's 37,000, not 40. Now, we have been given a value which is 37. So it means that now the monetary assets have increased from 25 to 37. Therefore, the difference there is 12,000. Difference there is 12,000. So we have to also convert now the increase in the asset. Again, we use the conversion for December, which is 300, and the average conversion factor rate there, which is 240. So we'll have 12,000 times 300 divided by 240, and that gives us 15,000. That gives us 15,000. Now, if you add the 15,000 to the conversion that we have found out for the 25,000, which is 37, you add now 37 plus the now the increase in the gain in the monetary liability that we have, that will give us 52,500. 52,500. And then the balance at the end of, not 52, that will be 52. So you move the 500. So 37 plus the increase, that gives us 2. Then you subtract the ending balance. The ending balance for the current assets was 37. If you subtract that, now what we'll have is 15,000. Now the net gain, the overall net gain will be found by looking at the gain in the monetary liabilities and the gain in monetary assets. So that gives us 17,500 minus 15,500, and that is 2,000. That is 2,000. Now, any question from the members? Hello. Yes. Coach, any question? Hello, keep quiet.
Understood.
Okay, so I want us to. Hello. So I want us to continue to the current purchasing power method. That is the advantage of current purchasing power methods. Number one is that this method can assist decision makers in evaluating trends when for a series of express units of constant purchasing power. The other advantage is that the shareholders keep purchasing power of their investments intact. So those are some of the advantages of the current purchasing power. Then we have the problems or the disadvantages. Number one is that the accountants. Two is that the price index to be used for the new assets. It is very difficult to maybe decide on a price index. That is because of the fluctuations on the prices of goods and services in a country. The other challenge is that you will find that the profits are always watched very closely, is watched very closely by business managers, government, and even the investors. Therefore, the management have got a lot of interest. So that may make it very difficult to use this. Finally, we also have the labor unions like COTU. They may also not on the adjustment of financial statements to affect inflation because they will affected in the financial statements. There may be an effect on the employee bonus that they will be given also. So those are some of the challenges of the current purchasing power. Now, I want us now to the treatment of purchasing power gain or loss. You have seen from the monetary assets and even the liabilities. For the example that we have done, we have a gain. So in some cases, you may find loss. So I want us to move to the discussion forum where you joined. There is also another button there. So I've already activated it. So please kindly, can we all move to the discussion forum so that we look at that example. If there is any challenge,